Good afternoon, everybody. Welcome to the 28th of September today. My final show for what's probably going to be the longest hiatus I think I've ever taken, including Power Trading Radio. I think the most I've ever taken off of Power Trading Radio was 10 days. I'm going to take 11 off for this one. I'm pretty sure that's what we're going to end up doing. Anyway, one for the road is the topic du jour today. I really just here to answer a bunch of questions, go over, I guess, some of the good stuff that happened in these equity markets today and commodity markets and just markets, period. So that will be our topic du jour. As was asked yesterday, am I going to have whiskey today? I thought, you know what, it is a Wednesday. I do have a lot to do. However, yeah, why not? I'm going with this is a rye whiskey out of, where is this from? This is El Dorado Hills, California, a place called Dry Diggins Distillery. It's called Rubicon Rye. It is absolutely delicious. So cheers, everybody. It's my Friday. I'm aware that it's not your Friday, but let's just pretend it is. Hope you all are doing great. Delicious. All right, I'm going to start from the bottom up and work our way through the market indexes. Pretty much everything was in the green today. Very happy with the way today turned out for myself. I had a little bit of portfolio protection, which was great. And then tomorrow, hopefully I'll make some final adjustments, and then I will just be smooth sailing. I don't have to really think about the markets as I'm traveling through Europe. So let's dive into the markets. Start with the bottom. It's always a good thing when you're long the triple Qs to say that the worst performer today was the NASDAQ, up 1.82%. You gotta love that. It's tough to call something the worst performer when it's up 1.82%. But here are your NASDAQ futures. This is NASDAQ 100 futures. You can see quite a very volatile range. You know, we mentioned over the past couple days that we're right in this area of demand. If I zoom out a little bit, it's that low point that we saw back here in June. So to me, if you're gonna get a bounce, this was the place to get it. And I said I'm a little bit nervous because it just doesn't look strong. But if you're going to get a bounce, this is where you're going to get it. My gut tells me we'll probably have a small bounce. I don't see it being huge. I mentioned on yesterday's show that I was anticipating a bigger market rally up to right around this 12,000 on the NASDAQ 100 futures. I still believe that is true. I think, you could get another 450-point move up to these highs at 12,000. But then I really don't see it going up too much further given all the macroeconomic negativity. Then we'll have to come back and revisit this and say, are we going to, let's put that line down there at the bottoms, cover those lows. And, there's your low right around called 11,000, right? Today, beautiful day, up 210 points. Got to love that. If we break that, though, and close down below 11,000 on the NASDAQ 100, then I think we've got more pain ahead and quite a bit of pain ahead. So glad to see the bounce today. I don't think we're done and out of the woods of this bearishness, but at least we could get a little bear market bounce here. Will I do any trading while you travel? No. I mean, I'm going to say no, but if all goes to hell and something went nuts in some of my positions, I may have to do some damage control. But I'm pretty safe in all the stuff that I'm in. I've got deep out of the money call options or put options. If we do get down there, I'm okay owning at lower levels, and when I get back, most of those options expire on the 21st. If they do exercise me, then I will just sell some calls against those, and I should be fine. But I plan on bringing a laptop, but that's predominantly for work-related things. Don't really want to do any trading. There's sometimes where you just need to get away from it and enjoy life for what it's worth. And for those of you who've never been over to Europe, especially Prague and Berlin and Munich and Amsterdam, last thing I want to do is be sitting there trading. Now, I was going to try to do something which would be kind of cool for me. I've been to some of the exchanges around Europe. Most of them are closed, right? Most of them turned from open outcry markets and auction markets to electronic exchanges. However, there still are some throughout Europe, and I'm going to see maybe if I can get to some of these old exchanges before they're boarded up and turned into Starbucks. Cheers, Chris. Good to see you. Happy Wednesday for you. Happy Friday for me. Thank you, Doug. Thanks. Thank you all. I mean, I appreciate the vacation. I know it's bittersweet because I do enjoy doing these shows every day. I feel like we got a pretty good community going here. But hey, got to take a break sometime. All right, so here's your Dow futures. Again, the Dow I'm kind of writing off, meaning I just don't like what it's done. It's broke down below those lows from June where everything else is holding. I'll show you in a second. So I personally don't really trade the Dow. Typically, if I'm trading ETFs, it's going to be the NASDAQ and the S&P and the Russell. Those are my three. I generally do not trade the Dow futures or the DIA. Here's your S&P 500, which, as we mentioned, did break down below those lows, but never closed below them. So, kind of giving it a little bit of slippage, if you will, that it did break down below those lows, but didn't close there. Had a nice little rally up. Can we get back up to 39? Man, that would be great. It'd be great if we got to 3,900. That's that last area that we started to see a big decline from. I just really don't feel that optimistic on our markets going forward. I expect to bounce, but I'd love it if we got to 39. That would definitely be a great level to bounce back up to. And if we get up to 39, I may have to make a couple trades. All right, moving on up our list. Here's our gold. Commodities did well today. Why? The dollar. We talked about the dollar extensively a couple days, or was it yesterday? I think it was. All hail the king. The dollar was yesterday or the day before. That had an impact on everything today when it slid. Dollar was down about 1.28%, and notice all our indexes up at least 1%, maybe more. Gold was up 1.92%, 1.97%. Beautiful looking move up. Again, I think it's headed right up to this 1,690 mark, which is the top area of that consolidation that we saw from a couple weeks back. Hopefully it breaks even higher than that because I'm long gold as well. I do have covered calls on my GLD position, so I'm earning premium there, and it was really good premium, I might say. So right now you're at 1668 on GL or the gold futures. Here's Bitcoin. Bitcoin and crypto did rather well, but I think that's just in sympathy with the overall markets. There's still a lot of dark clouds circling above the crypto industry because of these central bankers, and really you got to put yourself in the central banker's shoes. Crypto remains a threat. Crypto is a fundamental threat to their way of doing business and the way that they function. So they're going to do their best to spread fear and doubt, and they'll probably try to get some really harsh regulation put in place, but I think the government's a little bit better than that and maybe add some flexibility there. All right. Let's see, last two. So Bitcoin was number 3. Russell 2000 was your second place. 3.19% move up, which is awesome move up there in the Russell. And notice we had that 1640 line drawn. Man, pretty much spot on it today. Bounced off, nice rally. Hopefully get to this 1800 mark, possibly even that 1900 mark, but 1800 is what I'm shooting for the Russell 2000. And finally, last but definitely not least, monster move up in crude oil. Although I say monster move, but check out the moving average here when I throw it on this chart. I mean, you're still below the 20-period moving average. You're below the 50-period moving average. You're below the 200-period moving average. It doesn't look good for crude oil from a trend perspective, but it is nice to see this little bit of a relief rally, given the fact it's incurred so much pain over the past couple of weeks. You're probably going to come straight up to this, call it 83.50 mark, which is about another $1.70 above where we are at. That'd be about another 2% gain, 2.5% gain to the upside for crude oil, and I see that being very logical. We could draw trend lines across the top here if you wanted, but I think it's pretty clear to see we are in a pretty ugly downtrend here on crude oil. But nice pop up, 4.33%. And in my opinion, most of that was because of this bad boy right here. We talked about the dollar. I kind of felt at 114 we'd have a little bit of a pullback because it moved too far too fast, and here we are getting it. The question now becomes, where might this dollar sell off to? And it's kind of convenient because for me the target on this dollar is going to be 111. You guys can see that right there. It's kind of this rally-based rally out, and if the dollar does fall to 111, lo and behold, where do you think the S&P is going to go? Probably up to 3,900. Where do you think the gold's going to go? Probably up to the 1690 mark, right? Really, it's all about this dollar index. So let's, for anybody who's bullish out there, you want to see this dollar tank over the next week or two. Hopefully by the time I get back from Europe, it'll be at 111. And all will be fine. We'll be up in some supply zones. My options will expire worthless. I'll sell some more calls against it. Boom, Bob's your uncle, and I had a great trip. Last piece on this before we move on to listener questions was the bond market. So here's your 10-year today. Huge slide down, 5.4% slide in that 10-year bond. You also had a similar result in the 30-year, which is down 3.55%. But let's be honest, these are just pullbacks. I mean, you had really accelerated moves. It's just a pullback. Probably going to see this 10-year drop to 3.5, which would be a 50 basis point drop. I mean, that's a pretty significant move, but that's where I'm targeting the dollar or the 10-year bond to drop back down to, which might help out for some of this housing data and real estate markets. Now, you notice here I've got commodities, natural gas, wheat, we got lumber, cotton, corn, soybeans, all of which were positive today, including metals across the board except nickel. Nickel looking ugly. But nickel always looks ugly. I mean, look at this chart. This is a trash chart. But silver, 3.02%. Copper was up 295, palladium up 2.9%. So all in all, great day out there for commodities, metals, equities, everything except the US dollar. Even the euro and the British pound had surges today, and we'll talk more about that as I progress here through today. Big Ed says, don't count the dollar out. Nope, certainly not counting the dollar out. I think what you're seeing is, in a track and field event, the sprinters, they run really fast and aggressively for a short period of time, and then they stop, they put their hands in their knees, take a little bit of breather, take a break, and then come back and do another heat later. And I think that's pretty much what the dollar is going to do. It's going to take a little bit of a break here, and then going to come out for another next move to the upside. Gigi says, this time of year I used to travel to Europe too. Most of the children, most back at school. Tourists should be few. I really want to make sure the tourists are pretty much gone. After August, for those of you who have never been to Europe before, the last thing that you want to do is travel to any beach community in Italy, Spain, France during August. There's a thing called Ferragosto, which is basically Italians get the month of August off, and they all leave. I've never experienced anything like it. I lived in downtown Milan, and my first Ferragosto, I walked out of my building the third or fourth day of August, and it was really quiet. By the first week of August, ghost town. I stood in the middle of the street and just started screaming. It was like I was in a post-apocalyptic world. There were no trains running, there were no cars moving, there was not a pedestrian on the street, nothing. It was just like, what happens if I die and fall down in the street right now? No one's going to find me until they come back from vacation. Now, there were still people there, mainly tourists, but all the locals in Spain and in Italy and in France, they're all going seaside because August is their vacation day. So don't hurt yourself by going to vacation in Europe in August. Right now is a decent time except for the weather. Let's see. Liz says, do you think things could all fall apart again with tomorrow confirming final GDP and or CPI price? I don't think it's all going to fall apart. I think right now there's this general acceptance that things are going to get worse. I mean, the fact that Powell is saying what he's saying is just jaw-dropping to me. Just like so negative on unemployment. He thinks unemployment's going to rise, GDP is going to decline, feeling pain. I mean, we're going down on a lot of different fronts. But as far as could that data release that comes out really impact the markets? Absolutely. That said, let me real quickly show you a couple things here. I think it's really kind of, going back to what we talked about yesterday. Remember, we talked about a lot of bad data, right? We talked about this Case-Shiller Composite 20 Home Price Index curling over at the end. We talked about home price index numbers, which are Fannie Mae and Freddie Mac backed loan mortgages, the price declines of those homes, huge swings down to negative territory. New home sales are on a big slide. Existing home sales are on a big slide. And pending home sales were also looking weak. Now, I thought I would show you the current data because when I showed you this yesterday, we didn't have pending home sales. It was coming out today. And here's the numbers. Really not good. They were, one sec here. Yeah, there you go. They were expecting to be negative 0.9, so they thought it was going to get a little bit worse, going from negative 0.6 to negative 0.9. They were well over double the expectations. Came out at 2% slide in pending home sales, which backs up what many of you have been saying, is that when you have the amount of people backing out of their mortgage. Sorry, I'm thinking 18 different thoughts at once. The number of people who are backing out of mortgages or having deals fall through is surging, and that's a large part of why we're seeing this decline. So I wanted to show you that piece of data, but then since I don't have all of the data prepped for tomorrow, tomorrow we have our final GDP number, and I'll run through this at the end, but since you brought it up there, Liz, I think it's worth mentioning. Here's our final GDP number. They're expecting it to stay right where it's at negative 0.6. I don't think so. I think Jerome Powell's comments have made it pretty clear that they're expecting this to be worse than negative 0.6. So that's an interesting one. And then, of course, here for Friday's session, the big daddy is going to be this core PCE price index. And they're actually expecting prices to rise sharply here from 0.1% to 0.5. I don't think we'll be at 0.5. I think we'll be at 0.4, 0.3. But, I'm not making the data. Algos, hi Merlin. You call the bear market rally reversal in July. What's up? What's up this time? Well, I don't know if I called anything. I every day I'm making a call on what I think is going to happen, but it's not like I'm boasting about being right or wrong. It just simply is making trades. There are certainly other traders who will boast that they're right or wrong all the time. Look, I think at this point, if you're asking about where we're headed, Alexa, I think we're going to rally up for a little bit, maybe a couple days, maybe a week or so, but then we'll start drifting back down. Of course, That's based off the assumption that we're going to see inflation continue to stay at a high level. That's based off the assumption that we're going to see GDP numbers continue to decline. And that's based off the assumption that we're going to see employment or unemployment numbers start to rise. Those are three significant variables to support my hypothesis that markets will continue down. Now, any deviation from either one of those 3 points of data could change the story. Because if inflation comes out totally wrapped up under control, no big deal anymore, the Fed changes all their course of action. No longer going to be raising. If inflation stays high and GDP numbers continue really start to plummet, the faster they decline puts more pressure on the Fed to act and maybe focus on GDP, not necessarily inflation. So it's this giant chess game where, depending on where these pieces move, all the other moves change. So, I can say this today, which is the 28th of November, that I think we're going to have a little bit of a rally, just kind of a relief rally, if you will, and then more pain to follow, making new lows. That's just what I'm thinking today. It could be completely different going forward. But, I think the challenging part is when someone like me or a trader will say, this is what I think is going to happen, the key is to be flexible, right? You got to be real flexible with your assessment because things can change on a dime. And if you're a long-term holder, that can kill you if you're holding against the grain when something really starts railing against you. August nearly sounds like 15 days to flatten the curve. Yeah, it is. It's so bizarre, Tom. If you've never experienced it, I'm glad you said that because until COVID happened, I've never experienced anything like what happened in Milan during Ferragosto. They actually had record amount of people die because in August there was a heat wave in Milan while I was staying there, and I guess a lot of the old people stay. Right, the families and kids go out, and the old people stay at their homes, and there were record amounts of deaths in Milan because of the heat wave. People falling and no support staff for people to help them out, or just temperatures was just crazy. Yeah, it's a bizarre experience. But the other side is you go to the beaches, it's absolutely awful. It'd be like going to Daytona Beach during spring break. You can't find a spot anywhere. People are all rude and just idiots all over the place. Leave it alone. Tom says, would it be great to bounce up when the economy doesn't support higher valuations? Sounds unhealthy to me. I agree. I think the market's got a long way to go down, Tom. I think we are currently at unhealthy levels. However, I think that a normal decline in prices is healthy to have a bounce, pullback, drop, pullback, drop, pullback, right? Impulse and corrective phases. Those are two critical components of identifying the trend and the attitude of the trend. So when I say attitude, let's scroll up here real quick and look at the S&P 500. If you look at this chart, right? I know I've got some weird lines on here. Sorry, I'll see if I can get rid of some of these because I'll be different when I come back. If you look at the attitude, when I say attitude, it means where is the main emotion here? It's no surprise, it's no shock. You just look here and the attitude is down. The down moves are much more aggressive. They're sharper. The biggest red candles are on the down move, right? I think you guys all see that pretty clear. Let me just look back here in the middle of June. 3 monster red candles in a row. Now we have a couple big green ones, but the big ones are red and they're down, forceful moves. So that's what I mean by attitude. That's where you find your impulse. So our impulse is down. Corrective phases are going to be slower, right? And those are the ones that go counter trend. Now this one right here that happened from mid-June to August, mid-August, that was different, right? That felt like we were breaking trend, which is why it got me into long positions as soon as we broke this high. So I got caught with some nice losses right here at the beginning of August because I went long and had to recorrect myself as we started coming back down. Unfortunately, because I had been short, I remember I initially started shorting up here at 4,500, and I'm like loading the boat, did great on it, gave back a bit of the profit in this move up here, but it is what it is. Impulse corrective phases, so I think right now you're going to get a corrective phase up and then a next impulse down. Now, again, for those of you who are technicians, my feeling is that we will look like this. I'm going to draw this and leave it up here and see how it looks when we come back. And if we do the next leg, then I think you're looking at much lower. I have to scroll out here. I don't know if it'll be down here by the time I get back. I really don't think so. I kind of hope not, because that would be an additional, how big of a drop is that? Almost 20%. I'll call it 17%. But I think that's what's going to end up happening. We are in a series of lower lows, lower highs. If this is in fact a double bottom, then yeah, we'll go back up and hit all-time highs. I just think there's too much against that argument. Bad housing data, market goes up. Yeah. Well, I don't know if today's move is because of the housing data. I think today's move is just because of look how much it's fallen and how quickly it's fallen. And we're at a demand zone, right? So there's people who are looking saying, I'm going to buy here because that's where it bounced before. It's going to bounce again. And I think that's the main reason you're seeing the bounce. The question is, where's the conviction? How will it bounce? Yesterday we started to have a bounce and it gave it all back. Today we had a bounce and held it, right? So really it's about seeing how the rest of these next 2 days play out, given the fact you've got GDP and core PCE price index on Friday. Big time market moving stuff. So anyway, thought I'd share that with you real quick, and then I can go to some more listener questions. I'm scrolling back through here. I think you should propose. Thanks, GD. Who are you? Skipping October? Not skipping it. I'm just going to be gone for a little bit of it. You know, what's interesting is September, as you guys know, is the only month of the year that is historically has a negative rate of returns, like negative 0.2% going back to the 1950s. And the biggest market crashes typically happen in October. And it would not surprise me to see all of a sudden, a black swan, October, Black Friday type of sell-off happen in October. And hopefully I'll be short when that happens, but you never know. All right, let's see. Your little blue line just lined up. Let's go with high. Let me go to this question from Skilled Stocksman. This was sent in on YouTube, and again, I always encourage you guys to send in questions on the YouTube channel. I think that helps me out somehow by their algorithm, whatever, and I appreciate when the comments are there. Do you think the gilt market operation by the Bank of England is going to stop the pound from falling going forward, or is it just another temporary band-aid for the currency? Well, it's not per se the currency that they're doing this for. They're doing it for their bond market. And unfortunately, I don't have the 10-year or 5 or 10-year for the UK market on here. I don't even know the ticker symbol, but their yields on, let's just say, I think the 5-year went from like 1.4% to 4.4 in 2 months. That's a monstrous move to the upside. So what's happening is the cost of capital, and how many times have you guys heard me say this, that a rising bond yield increases the cost of capital for businesses. Well, the Bank of England came out yesterday and was like, listen, we have a serious problem here. The cost of capital has just quadrupled in 2 months. This is going to absolutely hurt our businesses. It's going to crush our economy. We have to do something. So gilt market operation, if you know what gilts are basically the same thing as treasuries. I think a government issued, long term, I'm making up the acronym, but it's basically their government bonds. So now the Bank of England is buying government bonds, just like the Fed was buying the Treasury's bonds. So it's their quantitative easing, which they say it's only for a small window of time. I believe it's from the 28th from today through October 14th. So it's like a 2-week window of time that they're going to be aggressively buying bonds. And it's funny because it says, when you read the description of what they're doing, there is no limit to what they can buy. They're like, we'll buy as many as we want. Remember, when they buy bonds, that means you have all this demand, which means the yield falls. As demand increases for bonds, yields fall, because the more people that are buying them, you don't have to pay as much reward or incentive to be buying those bonds. And that's the goal, is to drop that long-term debt cost of capital for these businesses in England, which are hurting. Now, how does that impact the British pound? I'll bring that up for us. Today you had a really nice bounce up in the British pound. And we were at 103 2 days ago. Not 2 days ago. On the 26th, we hit a low of 103.56, and today we're at 108. That is a huge swing to the upside here from a pip perspective on that British pound. And maybe the feeling is that by this operation that they're doing, this gilt market operation, that it's going to help their British pound out a little bit, give it some stability. What they can't have, and honestly, with all economies, you can't have your currency fall this much this quickly. I mean, this is unbelievably bad for a market. Well, it's good for some, bad for others, right? But let's just look at this two-day move. The British pound fell 8.47%. This is mind-boggling to think. Imagine that your purchasing power of your dollar dropped 8% in 2 days. It's one thing for Apple or Amazon or Microsoft or Cisco or Goldman Sachs or Wells Fargo or Bed Bath & Beyond to fall 8% in 2 daes. But a currency, a global powerhouse currency, the number 2 most powerful currency in the world to fall that much, blows your mind. The I-bonds, NJ says, when do I-bonds interest reset? The 1st of November. So November 1st is when they reset. Mortgage rates will... No, oh, okay, good point there, Robert. Robert says mortgage rates drop as a result. So if you currently hold a mortgage and it's a fixed rate mortgage, this means nothing to you, right? If you're looking to buy a property and get a mortgage, this is going to be great because I'm not sure how it is in the UK. They may be fixed to the LIBOR, not necessarily their 10-year, so it might be the LIBOR rate that the UK uses. I know here in the US, it's predominantly our 10-year. You can get some LIBOR loans, but most are off our 10-year. So let's assume, and I'm claiming ignorance here because I don't know how they price their mortgages in the UK, what it's based off of, but let's assume it's their 10-year. I think it's LIBOR, but let's assume. If it is the 10-year, then anybody who's looking to get a mortgage is probably going to be rewarded, right? Because if the 10-year is the basis and it drops, then all of a sudden they're going to be able to get loans much cheaper, which could help buoy the market, help people buy. So yes. Did the dollar raise 2%? No, not 2%. It was a good day, but not that good. I had it up here as... oh, I'm sorry. You mean against the British pound? Yeah. So here is, let's go look at the rally and the sell-off, right? So here's the dollar index. Remember, the dollar is mainly against the euro, but the dollar today was down 1.29%. Let me show you the British pound move, and I want to make sure I get the days right. That was from the 25th of September, 23rd to the 26th of September. If we go to the dollar index and go 23rd to 26th, that was a raise in the dollar index of about 3.11%. Crazy. You're right. I think you are right, GD. I think you are right. With all the LIBOR manipulation that went on, I think that the LIBOR is done. I don't know. I knew that they used to do all the loans off the LIBOR. I'm not sure how they're doing it over in Europe. So I'm sure one of you will tell me, and I will stand corrected. But yeah, the LIBOR, I believe, is... I remember they were going through all kinds of manipulation lawsuits. They may have just done away with that altogether. All right, so there you go. And for us, I mean, this is pretty insane, too. You don't see market moves that significant. I heard the UK banks are no longer issuing fixed-rate mortgages. Wow. That would be crazy, Liz, to not issue. I would never... Oh, thanks, John. Appreciate that. Secured Overnight Financing Rate, SOFR. Huh. I heard that acronym before, but didn't know that was what replaced it. So most likely that's what their mortgages are based off of, is that lending rate. Right? We used our 10-year. I know I had a friend who actually had a mortgage that was priced against the LIBOR years ago, and I was like, what's LIBOR? I didn't even know what it was. With all the different things in the world, I didn't even know what LIBOR was. Damn. All right, so Stocksman, I think that this is a grasp. I think it's like they're clutching on through just the fingernails on the cliff here, trying to backstop their bond market, which in turn will help backstop their currency market. But they said they're only doing it for a limited time. This should add some stability, but let's see what happens after they stop doing this purchase on October 14th. I believe they're supposed to sell at the end of October. So you're telling me they're going to buy an unlimited amount of bonds to prop up the bond market, then they're going to have to sell it at some point without manipulating the bond market. Maybe they should have taken a page out of the Fed's book, because the U.S. Federal Reserve has been doing this since 2009. Buying and buying and buying and buying. We started selling off a little bit in 2015, then realized how badly that impacted the market. They stopped doing that and then started buying more. And now we're unwinding. So, boy, it's one of those addictions. Like, as soon as the Bank of England starts buying long-term bonds, the gilt, and getting the obligations and keep purchasing, it's like crack. Once they start, they're not going to be able to stop. Oh, wow, Les, thank you very much, Les. Cheers. Cheers to that one. So yeah, this is a great soap opera piece we're experiencing right now. Screw reality TV. People want to watch the Kardashians and 90 Day Fiance, My 600-Pound Life, or 16 and Pregnant garbage. That's garbage manipulated BS. This stuff right here, this is the best soap opera you could possibly get involved with. It is awesome. Just keeps on getting more and more entertaining. Yeah, I'll verify it as well. I might have some research to do on the plane as I fly over to the UK. All right, let me go with one from our regular Mr. Tom Barr, who just sent in a comment. Just started SPX USD down 33%. Yep. Yeah, SPX, it's ugly. So let's go into this question here from Tom, which is a good one. He says, so I always wondered how SPX keeps in sync with the S&P 500 or so equities it represents. SPX isn't something you can own. It exists for options trading only. That's not even really true. SPX was not existing for options trading only. What SPX is it's a reference. It's basically saying, okay, the S&P 500 is 503 companies, right? That's decided by Standard & Poor's. The maker of the SPX index says we're just going to track the price of each of those 500 securities. So essentially, all they do is create a watch list, like I create right here, right? So here's a watch list of, I don't know, cryptos, right? You can see I've got last. All they're doing is tracking 503 securities. I know why they call it the S&P 500 when it's the 503, because it changes. There's been some splits, like Google split into two and other companies like that. So what they do is they're just literally just tracking this. They're tracking the price of those 503 securities. They don't own any of those securities. They don't earn any dividends. So XPX does not pay you dividends because they don't own anything. It's basically saying, hey, we're going to assume that we bought all these, but we're not going to buy anything. So that's why you can't own SPX, because SPX doesn't own anything, right? Now, one of the things people like about SPX is the fact that options are traded on it. It's a 10x value. So if you trade SPY, SPX is 10 times the value of SPY. So for what it's worth, you can buy less of the SPX and maybe you have to buy 10 SPY to equal that. Now, to go even further, the options on SPX are European options, which can only be exercised on the day of expiration or at expiration. And SPY is an American-style option, which you can exercise anytime you want. So two fundamental differences in the way that options are traded on those instruments. As I mentioned, the SPX is cash settled. There is no delivery of SPX. Whereas you trade SPY, SPY is a deliverable, and you could end up with shares of SPY. SPY is an exchange-traded fund. It is a fund that owns every single one of those stocks that are in the S&P 500. That's why they call it a fund. One important distinction here that you might all want to know, you have a lot of exchange-traded products, or ETPs. You have exchange-traded funds, which is a basket of actual ownership of security. So if something is an ETF, it owns something. If something's an ETN, an exchange-traded note, it may not own anything. It just has a piece of paper that says, oh, we own that. So very big distinction there. Exchange-traded fund, exchange-traded note, and there's a whole bunch of other different ones. So the SPY is an exchange-traded fund, therefore it actually owns all of those. So you get dividends with SPY, SPX you do not. The options on SPX are cash settle. The options on SPY are deliverable. You'll get shares of delivery if you're exercising the money. So a couple of, I think SPX was, I don't know about that, Margaret. I'm going to assume you're probably right on that SPX is around before SPY. So let's continue on with Tom's point here. The value of the SPX is bid up and down, supply and demand. Well, it's not, there is no extra supply of SPX. There's no supply of it, right? There's no outstanding shares. It's just simply you're buying the price that it is at that moment in time, period. So that makes it a little bit weird. Me and all my trader buddies will have to agree to disagree. It's just there for, yeah. Well, I'm pretty sure that SPX started as a tracking index and then options became part of it. So the chicken definitely came first in this example than the egg, but I'll let you disagree with me. That's totally fine. Meanwhile, those 500 or so ticker symbols need to have the right value so the index is at least near those 500. Remember, the S&P 500 is automatically or the SPX is automatically tracking those prices. So it's going to be almost identical to the SPY, other than the fact it's 1/10 the value. All right? How are they pulled in line with each other? If SPX traders are going crazy in one direction, what forces SPX to get in line with forces? So again, they're not, if people are buying as much SPX as possible, they're not driving the price up. You're just buying a quote, all right? You're buying a quote of the index. Now, if you look at SPY, that's different, right? SPY, you're actually buying those 503 securities, and that could have an impact on price. What's unique about having something like SPY, SPX, and S&P futures is should there become a major discrepancy between the two, right? SPY is more likely to come out of line because of supply and demand. SPX is not. SPX is just saying we're tracking those prices. That's what it is. If 1 million people want to buy SPX, it doesn't matter. You're just buying the price that it's quoted at that moment in time. It's not. You could have 1 million times more demand than supply for SPX. It's not going to change it. Now, of course, maybe the options that you're buying or selling against that SPX could influence the markets, but that's a different story. So, who take advantage of the small difference? Yes, so to Margaret's point here, you could have arbitrage. And arbitrage traders could be using the S&P futures, the SPY, and SPX to, I guess, bring back those imbalances should they get out of whack. So I think SPX is a good vehicle to help keep the market in line and prevent runaway discrepancies between SPX and S&P futures. So Karen says spread is much larger on SPX than SPY. Remember, the spread is the price of those options are generally 10 times more, right? The price of the option of the underlier is 10 times more. So you're going to have a wider spread. The bigger the price, the bigger the spread, typically, correct? So yes, SPX. So theoretically, SPX and SPY should be identical, theoretically. But again, if there's too much demand or supply for SPY at any moment in time, you might get slight variations, but it's never going to be overly dramatic. Yep. Yeah, SPX is great. You know, I don't know why I got to claim, just kind of shrug my shoulders and go, I don't know why that is, but I have always been just smug and content with SPY. I probably could have done better trading the SPX. Simply, I think many of the main reasons I like SPY better for options trading is I can get out when I want to. If I want to bail right now, I can do so. A little more challenging with SPX. I mean, you can sell them in the current marketplace, but as far as exercising, I can exercise them when I want if I'm using SPY. But they're all great trading vehicles. So there you go, Tom. I hope that helped answer your question. Because it's just the SPX is just I'm watching the prices. You don't actually own anything. SPY you do, and then you can use the futures SPY to arbitrage should there be any discrepancies with SPX. I think I got it. How much time we got? Oh man, 37. All right, I think I had one more question that came through, unless I get one more for you. No, I didn't. Actually, I did have this one here from Jeff. I think Jeff is here today. According to my analysis and my confirmation from Algos, it's the start of a reversal. Buy the dip starts. Well, everything works until it doesn't. Avadhut. Cool name. Avad. I'll call you Avad. Everything works until it doesn't, Avad. And, one of the things that I love about trading is you can have all the signals in the world tell you that something is going up and the markets just continue to go down. The beauty of the market, and this is the thing that is so challenging. I know Tom got a bit of an engineering background, and it probably is one of those pieces that frustrates you the most when you're like, "This is telling me it's going down. This. These. I have 10 things all saying these markets are going down, and the market just goes up." And you're like, "How does that happen?" Because price is going to do what it needs to do. So you may have an algo and signals and signs that say markets are going up right now. I think you're right. But I'm not basing off of... You notice when I look at this price chart, do you see me referencing any algos, any trading systems? I'm just looking at the price chart. And it's just easier that way. And I think that if you pulled up different price... Like if I pulled up yesterday's chart, which is right here, let's say this chart of the S&P 500, and I added on stochastics. Right? What do you guys think stochastics would have told me yesterday? It probably was going to tell me it's oversold. So let's just do it just for fun. Let's add on stochastics here, and I'll go stochastics. I'll just do regular stochastics. Look, it's been oversold for the past 5 days. I don't need an indicator, and it's just giving me a buy signal right now, which is great. Hey, Big Gab, good to see you, my friend. You missed the farewell. We just did whiskey shots. I was doing body shots. You missed it. Oh well. We could pull up indicator after indicator, and it'll tell you that we're oversold, we're in an overextended downside. I could bring up Bollinger Bands, and we're probably popped out the lower Bollinger Band. That still doesn't mean we have to buy right here. My main signal to buy is that we're hitting this demand zone from June 17th and now bouncing off of it. Does it help me to look at stochastics? Here's why I say yes. Because there's a lot of people out there that are looking for stochastics as a buy signal. And if they get a buy signal, I'm already in, because it came into demand and are bouncing. Now, the other indicators will tell us the same thing. Let's see if I can get rid of this and add on Bollinger Band just to see, because Bollinger Band is going to be a little bit iffy, but it should be outside. It should be hugging the lower Bollinger Band. And let's see. So there, the last 3 days, we've been outside that lower Bollinger Band. Well, you could have made the argument that any one of those is a buy point, and now all of a sudden you're confirmed. Oh, we're outside the lower Bollinger Band. Here we are, moving to the upside. There you go. So I don't know. You guys know me. I I like indicators. I think they can help you. They give you that pat in the back like, hey, you're doing the right thing, buddy. Good job. But look at price. Price is the most important thing that you're going to have here in helping you move forward. When you least expect something to happen in the market, yep, that's exactly when it happens. My mentor was a very stoic guy, kind of an interesting one. He used to always say this. He goes, the market train leaves its station with as few people on board as possible. And as soon as everybody's on board that train, it stops and goes the other way. And it took me a while to really understand that. But what he means is, if you look at this market chart right here, how many people do you think are long right there? Not many. Not many. Why? Because it's a market panic. You get everybody in the news now saying bad things about the economy, bad things about the market. Jerome Powell's basically saying, you just grab your ankles, you're in trouble. You're screwed now. We're going to keep raising and tightening. It's freaking everybody out and everybody's selling. Well, the train has almost no longs on board. So what's going to happen? Train's going to go the opposite direction. All of a sudden, you get a whole bunch of people jump in, they'll buy it long, and then you get a nice little move up, and then it'll rip back the other way as soon as everybody gets long. So think of that when you see these big impulsive moves or stretches that everybody was already out. Or not everybody was out. Let me take that back. There's no way everybody was out, but a large portion of people were bailing and jumping ship, and we can see that reflected by the price slide. I mean, this price change for the short window of time that it is for the S&P, and I'll just go from here to the low we achieved today, you're looking at a slide of 13.53% in 11 trading sessions. That's 2 weeks the market's dropped over 13%. That is crazy. That's not a normal move. So it's bound to happen that we have a bounce up because people were panicking here. Now we'll have a little bit of a bounce up, and then it'll probably continue back down. So anyway, we could go. The Brits pulled a nice surprise there. The tax cut and doing their Operation Twist over there, or quantitative easing for them. Yeah. Doug says the great bond sell-off is Japan starting a trend? Do they think it will ultimately push the U.S. dollar down worldwide? Who knows? Japan has been in a problem for the past 20-plus years, so I have no real inclination to follow what Japan has done historically and say that that's a working model. I mean, their economy has not been doing great, so I wouldn't trust them. No problem, Varut. Yeah, unfortunately, I don't cover Indian markets. Brandon Wendell, who used to be I used to have on the show quite a bit. He lived in India, so he loves covering the Indian markets. And I mean, I could probably cover an Indian index and give market commentary just because price is price, right? Human behavior is human behavior, whether I'm in India, whether I'm in Dubai, whether I'm in London or Sydney or U.S. And it's all understanding how people react to certain data. When it comes to the market, I've learned to never say, well, never. Oh, yeah. It's funny. I used to always tell people this, to students particularly, that if you ever find yourself saying it can't go any lower, then you better sell your long positions because it's going to keep going lower. It'll keep going lower until you finally get out, and then it will turn. And if you don't get out today, it's going to drop tomorrow. And if you don't get out tomorrow, it's going to drop the next day. But the day you get out, it turns the other way. The beauty of markets. And the other side of that's true is this can't keep going up any higher. Usually was what people say when they're short. Oh, it can't keep going up. I'm getting killed. Just close your short position. Get out of it. Be done with it. All right, so I'm going to wrap things up here as I've got a ton to do to get ready. And, of course, no show tomorrow, or no show for the next couple weeks. Apologize for that, but got to do what I got to do. Here is your economic calendar. I didn't take screenshots, so I'll just go from the calendar itself. Obviously, tomorrow is a big day because of the GDP numbers. Not only do you have GDP numbers for Canada, but all eyes are on this one right here, which is going to be at 5:30 Pacific time. An hour before the markets open, you get that GDP number come out, final GDP. Pretty much baked in that we're going to be at negative 0.6 is what people are expecting. But given the recent talk track by Jerome Powell, I kind of think it's going to be higher than that. I really do think it's going to be a little bit higher than negative 0.6, just showing the weakness out there in global business and our place in it. Other things you have on there, I mean, you do have some retail sales numbers for coming out for Japan, as well as their unemployment rate, which is 2.6% right now. They're even better than the U.S. Everybody's working over in Japan. Work. You also have unemployment claims coming out for the U.S. and final GDP price index. They move over to Friday, which is really the big day for me. You have at 5:30 in the morning on Friday, core PCE price index. That's a biggie, and I do think you're going to see a miss on this one. I don't think it's going to be as high as 0.5. I think it's going to be 0.4 or 0.3. It's just slightly below that. Don't be watching the reruns, Big Ed. You'll drive yourself crazy. Do you know the date of your next show? Yes, I do. So if everything goes well and I don't come back sick as a dog or I miss my flights, whatever, I should be back on the saddle on the 14th of October. Let me real quickly check here. Yeah, the Friday the 14th. I think I arrive on the 14th, but I'm just going to come straight over and just do a show. Pull a Chevy Chase and get in Oktoberfest. Gary, you don't know. Hey, you got your chat working. I'm not a fighter, especially at Oktoberfest. I'm one of the funny drunks, so when I get drunk, I start doing silly stuff, and yeah, I'm definitely not a fighter. No reason to be. Life's too short to be a fighter. All right, when you're gone, just open up the chat box at 2 p.m. every day so you have fun show. I'll just put my phone somewhere, just set it on a window, and just let it go for 40 minutes. All right, well, I'll try to put some pictures on Instagram for you guys. I normally don't do it, but since it is a TraderMerlin Instagram, I will put the TraderMerlin pictures on there. Yeah, it should be a fun time. Thank you guys for the patience. I know it sucks I'm going to be gone for that long, but you know we all got to take a vacation sometime. So I'm going to take a little over 2 weeks on this one, and then we'll see what the next one is. Get a flu shot? So the flu shot doesn't really work for anybody. We won't get in the vaccine debate. All right, that's going to do it for me, everybody. Again, if you have comments, questions, things you want me to talk about, who knows, maybe it'll spur me to do something during my trip over there if I find some time and get all excited about creating some content. You can email me at tradermerlin@gmail.com or just put your comments down below the YouTube videos. That's the easiest way to get comments answered on the program. I usually put them into the slides chat here and answer those all. So thank you guys so much. Have a fantastic remainder of your week. Be careful out there. It's going to be a wild one for the last couple days, and I'll see you guys on the 14th of October. Cheers.